So your business relies on heavy machinery, which means your next purchase is one of the biggest decisions you'll make. And it's not just about the machine itself, right? It's about how you're going to pay for it. Well, today, we're going to break down the world of equipment financing so you can make the absolute smartest choice for your company.
You've seen the ads everywhere, I know you have. Get this brand new machine with 0% financing. It just sounds like a dream deal, doesn't it? But is it really? Let's dig in and get to the bottom of what that offer actually means for your wallet.
All right, so let's start with that super tempting 0% offer. When a lender says you won't pay a dime in interest, what's really going on behind the scenes?
Okay, so at its core, 0% financing is exactly what it sounds like, a loan without interest for a set amount of time. It's a really powerful marketing tool, designed to grab your attention and close the deal fast. But, and this is a big but, it's absolutely crucial to remember this is never, ever free money.
So how do they make up for that lost interest? I mean, they're not just going to take a loss, right? Well, a lot of the time, that cost is just hidden somewhere else. Maybe it's a higher sticker price on the machine itself, or they'll try to upsell you on expensive warranties, or maybe the payment terms are less flexible. The main takeaway here is you've always got to look past that headline offer. All right, so beyond those slick promotional offers, your choice really boils down to two main paths. You can either take out a loan to buy the equipment, or you can lease it. And trust me, each one has totally different implications for your business. An equipment loan is pretty straightforward. You borrow the money, you buy the machine, and boom, it's yours. You own it. And every single payment you make builds equity, kind of like a mortgage on a house. So this is your go-to option if you want to own your assets for the long haul.
Now, a lease, on the other hand, is all about usage, not ownership. Think of an operating lease like a long-term rental. It's fantastic for equipment you know you're going to want to upgrade pretty frequently. Then there's a capital lease, which is more like a rent-to-own deal, where you might have the option to buy it when the term is up.
And this is where things get really interesting. The taxes. With an operating lease, your full annual payments can often be deducted as a business expense in that same year. That gives you an immediate tax benefit. But when you buy, you usually deduct the cost over time through depreciation. In Canada, for instance, they call this the Capital Cost Allowance, or CCA. So the bottom line is, leasing can give you that quick tax relief, while buying spreads that benefit out over years.
Okay, whether you lease or buy, the devil, as they say, is always in the details. The real cost of any financing agreement is almost always hiding in the fine print. So let's talk about what you really need to watch out for.
Here's a classic trip-up. Interest rate versus APR. They are not the same thing. The interest rate is just the cost of borrowing the money, period. The APR, or annual percentage rate, is the total cost. It includes that interest rate plus any other fees they've wrapped into the loan. So the APR is always going to be a higher number, and it gives you a much truer picture of what you're actually paying.
You also have to be super careful about how tax authorities view your agreement. See, in many countries, there are rules that can actually reclassify what you think is a lease as a purchase, at least for tax purposes. For example, the Canada Revenue Agency will flag deals where the buyout price is way below market value, or the lease covers most of the machine's life. If that happens, you could lose all those great tax benefits of leasing.
And finally, please never forget the total cost of ownership. That monthly payment, it's just one piece of the puzzle. You've also got to factor in maintenance, repairs, insurance, fuel, the whole shebang. A really low monthly payment on a machine that's always breaking down could end up costing you way more in the long run.
We've talked a lot about the costs and the risks, but let's flip the script and talk about the upside. Why do so many successful businesses choose to finance their equipment? Well, because when you do it right, it's an incredibly smart, strategic move.
And you can see right here, the number one reason by a long shot is to preserve cash flow. It lets you keep your capital free for things like payroll, inventory, or jumping on new opportunities. Financing also gives you access to better, more advanced equipment than you might be able to afford outright, and that in turn boosts your productivity and your company's reputation.
At the end of the day, financing isn't just about being able to afford one machine. It's about maintaining the financial health and the agility of your entire business. It basically turns a massive one-time expense into a predictable, manageable operating cost.
So with all this information, how do you actually put it into action? The process might seem a little intimidating, but it really just boils down to a few clear, simple steps.
At the end of the day, it's really this simple. You apply, You review the financing options that you get back, you choose your machine, and you get it delivered to the job site so you can get to work. The real key here is to do your homework before you hit step 1, so you know exactly what you're looking for in a good offer.
And that really brings us to the final, crucial question you need to ask yourself. Is this next machine a long-term asset that you want to own and build equity in, or is it simply a tool you need to get a job done for a specific period of time? Your answer to that question is what will guide you to the perfect financing path for your business. Thanks for tuning in.